John Hilsenrath, our intrepid Fed watcher in Washington, is here to join us. Bernanke was giving a different, well, we've had him twice now in less than 24 hours, John, the Fed chairman. Yesterday in a lecture.
He's got a busy week this week.
Isn't he?
He was lecturing college students yesterday, and now he was before Congress today testifying on the European financial crisis and how it affects the U.S. Some people might argue he got some better questions from the college students than he got from lawmakers today.
What do you have to say about the Euro crisis? He's not out of the woods, right, he's saying?
You know, I think the message is that it's not that conditions have improved. There's certainly a sense of relief at the Fed right now that it hasn't become another financial crisis. That was a worry back at the end of last year. Now it looks like they've at least managed to kind of tamp things down. But there's still a lot of problems. You know, not only the risk of another financial flare-up, but you know, we're dealing with a major trading partner right now that is looking at a very long stretch of subdued growth. So,
right.
You know, it's still clearly very much on the Fed's radar screen.
You know, we just had an interview with a PIMCO executive talking about PIMCO's position, and they're shifting to a strong dollar position precisely because of the concerns they see in Europe. And they're saying something that we're hearing from a lot of people, and that is that it is, you know, yes, we got through the Greece problem, but there's still this phenomenal problem of slowing growth and the risks to Portugal and so forth. So, you know, there really is a major concern out there. But having got through this phase now, does the Fed see itself as being a player in this? I mean, he attributed the improvement in liquidities perhaps to some of the measures taken in Europe.
So does the Fed see itself as being a what?
As being a player. I mean, the Fed, in fact, you know, helped out with, you know, dollar funding through the swap lines and sort of.
Yeah, you know, and these swap lines are an interesting twist. You know, the Fed gets a lot of flack for them up on Congress because there's this perception that the Fed is bailing out European banks. You know, Bernanke defended the lines, and he actually thinks, you know, as he explained today and as he's explained before, that they have helped to reduce the probability that problems in Europe are going to be transmitted to the United States. Right. You know, so the problem is you have these European banks who take out a lot of U.S. dollar loans and buy U.S. dollar assets. What the Fed doesn't want to happen is for those banks to be short of dollar loans and have to sell off their assets. So the Fed thinks that its swap program has been pretty successful. They're very committed to it.
Now, just quickly, John, give a little bit on the lecture yesterday. You talked a lot about the gold standard. Any signals there for contemporary policy, or just a walk through history?
Yeah, I mean, the signal was a political signal on the gold standard. You know, the Fed has taken a lot of hits from the right who think that the central bank has been reckless and that monetary policy is arbitrary, and they want to tie monetary policy to a gold standard. He gave a very long discussion yesterday on why that would be a terrible idea. I did think there was a subtle signal that didn't have to do with the gold standard. You know, Bernanke was talking about the founding of the Fed and some economic history, and what I picked up on today was he talked about the double-dip recession in the 1930s that became the Great Depression, and said that the Fed was too quick to raise interest rates after it looked like things were improving, and that the lesson from that period is that the Fed should not be too aggressive about taking away the medicine that's making the economy stronger. Today, this is important because the markets right now have been pricing in a Fed that tightens policy a year, raises interest rates a year before the Fed has said it expects to. The market sees the Fed becoming more hawkish than the Fed expects. I think what Bernanke subtly said was, hey, out there, I'm not in any rush. You know, he is taking his cues from the Great Depression and thinking that.
And there are parallels there.
Take his time.
There are parallels there. It's an interesting one.